What confirms a high is a higher high and low is a lower low, and what is an inducement? In earlier section of this video, we learned about what confirms a low as a higher low and what confirms a high as a lower high. This is done through a break in the main structure. A low is considered higher low when the price breaks to the last high of the main structure. Similarly, a high is considered a lower high when the price breaks the last low of the main structure. Now, what confirms a high as a higher high? When the price moves to the upside and breaks the last high's major structure, this break does not confirm the new high become a higher high. Instead, it confirms a higher low. A high is confirmed as a higher high only when there is a break in the minor structure to the downside. This first low break of structure from a minor structure is called an inducement. Remember when I said earlier in the video, inducement is one of the terms used to refer to a high or a low in the market structure. In simpler terms, an inducement is the first low of the minor structure that breaks to the downside, creating a reversal from an uptrend to a downtrend on the minor structure. This shift confirms the occurrence of a higher high in a major structure. A higher high in the major structure cannot be verified unless there is a breach in the low of the minor structure. This is because the minor structure may persist in an uptrend pattern. To confirm that the low of the minor structure serves as a trigger, a minor downward breach in the structure must be observed. This breach confirms that the low has become a trigger and validated the occurrence of a higher high in the major structure. The same thing confirms a low as a lower low. When the prices moves to the downside and breaks the last low's main structure, this break does not confirm the new low becomes a lower low. Instead, it confirms a lower high. A low is confirmed as a lower low only when there is a break in the minor structure to the upside. This first high break of structure from a minor structure is also called an inducement. In simpler terms, an inducement is the first high of a minor structure that breaks to the upside, creating a reversal from a downtrend to an uptrend on the minor structure. This shift confirms the occurrence of a lower low in the major structure. It is crucial to recognize that a lower low in the major structure cannot be verified unless there is a breach in the high of a minor structure. This is because the internal structure may persist in a downward zigzag pattern. To confirm that the high of the minor structure serves as a trigger, a minor upward breach in the structure must be observed. This breach confirms that the high has become a trigger and validates the occurrence of a lower low in the major structure. Please remember this. Inducement is a crucial aspect of a smart money concept, serving as its backbone. Understanding this subject is clearly essential. Differentiating between major and minor structure and identifying the inducement can be confusing for traders. However, using the right approach to identify them correctly is important. Now, here are some tips to help you read swing highs and lows and their pullback in both minor and major structure. Step 1. Use a higher time frame to identify major structure. For example, if you are a day trader, you may use the daily or H4 time frame to identify major structure. Look for the trend's highest high and lowest low point in the major structure. These are the highs and the lows of major structure. Now wait for the break of structure to the downside or upside. Once there is the break of structure, you will get either a lower high or a higher low. Step 2. Go to a lower time frame to identify minor structures. For example, If your major structure is from the daily time frame, you may use H4 or 1 hour time frame to identify minor structure. Look for the swing highs and lows of the minor structure within the range of the major structure. These are the smaller swings within the overall trend. Step 3. Identify the inducement by looking for a pullback in the minor structure. If the major structure breaks the low, you want to see a small pullback to the upside in the minor structure. You want to see that pullback is breached because that confirms lower low in the big structure. If it doesn't break, wait for another pullback until it is breached. Similarly, when looking at the major structure to the upside, a breakout confirms that the previous low has become a higher low. At this point, it's important to identify the swing highs and lows of the minor structure within the range of the major structure. These smaller highs and lows occur within the overall trend. Next, identify the inducement by looking for a pullback in the minor structure. If the major structure breaks the high, wait for the small pullback that occurred in the minor structure to the downside. It's important to see that this pullback breach because it confirms the big structure higher high. If the pullback doesn't break, then you should wait for another pullback until it is breached. By following these steps, you can differentiate between major and minor structures and find the inducement. Now, it's time to put all this boring theory into practice like a true market whisperer. Don't worry, I won't reveal my secret entry techniques yet. We will begin with the basics, such as how to read market structure for any asset and time frame. You will learn how to spot the break of structure, whether a high is a higher high or lower high, whether a low is a lower low or a higher low, and how to identify inducement before taking any entry. All right, let's get started in the next video.